Hello, options traders and Facebook fans. And I want to give a special welcome to all of the new members we've had here in this past week. Had quite a few new members and appreciate that. So please continue to invite your friends, because the more people we have in here, the more that everybody will learn. And in this video, I want to talk a little bit about the power of gamma. This video is really a response to the most recent poll that I put here in this Facebook page, talking about a hypothetical situation where we have this perfect crystal ball that gives us absolutely perfect information about the future. And it tells us that ABC stock is going up. And the poll question said, given this information, we're going to assume that we have perfect information about the direction of the stock. Which of the following trades do you choose? Would you buy a call? Would you sell a call? Would you buy a put? Or would you sell a put? Obviously, there are many more strategies we could choose, but I just want to make the point by limiting it to these four. Now, most people jumped on what seemed to be the most logical answer of buying a call. Why? Because you heard the word up. The stock is going up. We've got perfect confidence that it's going up, and everybody thinks, therefore, you should buy a call. Well, the real answer is that we should, in this instance, be selling a put. Now, why do I say that? To understand why, we have to turn to our Greeks, which are just option risk measures. We can use them in many other ways other than just for measuring risk, but they are a vital part for success, and especially with advanced strategies in options. And the 5 key Greeks that you need to understand are delta, gamma, theta, vega, and rho. And in this video, we are going to talk mostly about the power of gamma. To appreciate gamma and why you have to consider it before placing an options trade is to remember that options are two-dimensional. And I've talked about this several times in previous videos. But as a recap, let's say we're taking a look at Apple stock here. If you are a stock trader, what do you need to know? You just need to know if the stock is going up or down. That's all you need in your assessment to figure out what you should be doing. You think it's going up, you buy the shares. You think it's going down, you can short the shares. It's that simple. And that's because stock is a one-dimensional asset. Options are two-dimensional. And actually, they're multi-dimensional because we have lots of different Greeks and lots of different factors that go into an options price. But to keep it simple and to drive home the point of gamma, let's just say that they're two-dimensional. So with options, not only do we need to determine if the stock is going up or down, but let's say if we have this 155 call, we also need to determine if that speed is going to be slow or fast. Up or down by itself is almost meaningless in the world of options. We have to also assess how quickly or how aggressively that stock price is going to move, and that makes all the difference in the world. To show why options have a speed component to them, let's take a look at some Apple quotes. And here we've got 96 days till expiration, and the stock here is trading for, let's call it 157. And let's say the 155 call over here is trading for $8.20 on the mark. And for the same strike put, it is $6.15. Let's start by considering the 155 call break even. Remember, to find a call options break even, you add the strike price to the options market price, or to the price that you end up paying for it. So in this example, if we have the 155 strike and it costs us $8.20, that means the stock has to be 163.20 at expiration just to get our money back. In other words, the stock price must rise $6.20 just to break even. That's a 4% price increase. The 2 key words you have to focus on here are must rise. There is a speed component when you buy a call. We absolutely need the stock price to rise before we're going to make money. For put options, we subtract the options market price from the strike price. So in this example, the 155 put was trading for $6.15. So 155 minus 6.15 is 148.85. In other words, we need the stock price to fall from its current price of 157 down to 148.85 by expiration just to break even. So the stock must fall $8.15 just to break even. That's a 5% drop in price. The two key words to focus on here are must fall. Again, we have a speed component. Notice when we were talking about calls, we needed the stock to rise, but we had that word must in there. When we're talking about puts, we need it to fall, but we have that word must. We absolutely need the stock price to move before we're going to make money with any option that we buy. So remember, when you're buying options, there is a need for speed. Long options, those are ones that you buy, need the stock price to move. There is a speed component to any option that you buy. Now, of course, the more at the money or more out of the money you go, the more you're going to need that stock price to move. The more in the money you go, the less you will need that stock price to move. But no matter which strike you pick, you absolutely need that stock price to move. And one of the ways to understand this speed component is by gamma. To understand how to better construct an options trade, let's take a look at delta and gamma versus long calls and long puts. If you buy a call, it's a long call, you have positive delta. That means you need the stock price to rise. You're bullish on the position. If you buy a put, you have negative delta. You need the stock price to fall. But as I've just shown, long calls will have positive gamma and long puts will have positive gamma because they are long positions and you therefore need the stock to move. If you need the stock to move, you have positive gamma. So remember, anytime you buy an option, you've got positive gamma. The deltas for an option is just showing the stock component of the option. So you can think of a position that has positive delta like long shares of stock. So if you own 100 shares of stock at 50, this is what your profit and loss diagram looks like. It has positive deltas. And very simply, that just means if the stock price rises, we go into gains. And if the stock price falls, we go into losses. That's what positive delta means. We need the stock price to rise. Negative deltas, on the other hand, have the profit and loss diagram leaning to the left like this. This is what a short stock position would look like. So if you have a short stock position, you have negative deltas. And that just means we need the stock price to move in this direction, to fall, before we start heading into gains. If the stock price rises, we're going to head into losses. So anytime you have an option position that has negative delta, you want to see that stock price fall. However, when you're dealing with options, you have more than just a delta component. You have a curvature to that option's price, and that's one way of understanding gamma. So here's the profit and loss diagram for a long $50 call, and that's what it looks like at expiration. Let's say a few seconds before that bell rings at expiration. But prior to that, let's say 30 days out, the profit and loss curve is not going to look like this in yellow, but instead it's going to have a curvature to it. And the more curvature you have in this profit and loss diagram, the more gamma you have. The more gamma you have, the more you need that stock price to move. Delta and gamma can sometimes be a bit difficult to conceptualize, so let's consider a simple example with a long stock position. Let's say you have 100 shares of stock trading for 100, and the stock rises to 101. You are up $1. If the stock goes to 102, you are up $2. 103, you're up $3, and so on. 4, 5, and 6, you are just moving dollar for dollar with the stock. And that's because you have pure deltas. The stock buyer always gains and loses dollar for dollar with the stock. Notice that when the stock price went from 100 to 101, that was a $1 gain. When it went from 101 to 102, that was also a $1 gain. From 102 to 103 is also a $1 gain. 3 to 4, also a $1 gain, and so on. So as I just said, every time the stock price moves up $1, you are therefore gaining $1 as the stock buyer. This is your delta. How much your profit and loss is changing with each dollar move in the stock. Obviously, the stock trader earns dollar for dollar. He's holding the actual asset. This is not true for options traders. When that stock price rises $1, the call buyer is not necessarily going to pick up a full dollar, and instead he's going to pick up something less than that. But now let's take a look at how the rate of change of those deltas moves. Look at this first change here going from this first dollar gain to the second dollar gain. There's no difference between them. Both changes in the stock produced a $1 gain. What about the next changes when we went up from 102 to 103? Both cases netted a $1 gain. There's no difference in those answers. The next set, up a dollar, up a dollar. There's no difference in those answers. Moving between this pair right here, dollar and a dollar, there's no difference between those two. It's the same answer. And over here from 105 to 106, again, $1 and $1 is exactly the same. There's no difference. This down here, the rate of change of your deltas, is gamma. So this is a very simple way to show that a long stock position, stock that you own, has delta of 1 and gamma of 0. When you are trading options, in most cases you will have deltas less than 1, but you will have gamma. Those deltas are going to change. And here's the real power of it. Let's take a look at a couple of strategies here. In red, we have 50 shares of stock purchased at 100, and in green, we have one call option. Now, I think most of you know that if you have an at-the-money option, you're going to have 50 deltas. It's not going to behave like 100 shares of stock. So think about it. If you have 50 shares of stock and you have one call option with 50 deltas, both strategies there are behaving like 50 shares of stock. And that's why the red and green lines overlap in this very tight range in here. But if the stock price starts to move in our favor and starts to rise, take a look what happens to our call option. We actually get more profitable than the long stock trader. That's gamma coming to our advantage. We can actually make more than a long stock position if we're correct. Now take a look if the stock price falls and goes against us. Here's the power of gamma. The stock trader loses dollar for dollar, but the options trader starts losing less than dollar for dollar. This is gamma coming to your rescue when things go wrong. So the real power of gamma means that as an options trader, we can earn more than a stock trader and we can lose less. Now let's go back to the hypothetical poll question. We have this perfect crystal ball. It says that ABC is going up. What do we know? We know up. We know direction. That would work if we're a stock trader. That's all we'd need to know. We could buy shares of stock, and that would be one viable strategy. Unfortunately, it wasn't one of our answers. What else do we know? The crystal ball says nothing about the speed at which it's going to go up, or the magnitude. Is it going to go up a penny? That's still up. Is it going to go up $5 or $10 or 50 or 100? Those are different degrees, different magnitudes, and it says nothing about that. And this is why so many new traders get trapped with certain option strategies, because somebody tells them the stock is going up and they jump right on a call option without considering the speed or the gamma. So how can we polish up this trade here? Well, just remember that option sellers, being on the opposite side of the trade, have the opposite deltas and gammas. So here's the previous chart on top that we saw before, but let's take a look at the short positions. Notice everything is opposite. If I sell a call, I have negative delta. If I sell a put, I have positive delta, exactly the opposite of the long positions. But also, I have negative gamma. So now the crystal ball tells us that the stock is going up. As an options trader, what do you know? Positive delta. We don't want negative delta, we want positive delta. But what else do we want? We don't want gamma. We want negative gamma, or zero gamma is another position that could work. But given these four trades, we have a choice of only positive or negative gamma. So we'd ideally like to have positive delta and negative gamma. And now, given what the crystal ball has told us, we can think like an options trader. We know we have to line up two dimensions correctly, direction and speed. Remember, for stock traders, all we need to do is think direction. We don't need to think speed. As an options trader, we do. So what do we know? What's our direction here? Bullish. What's our speed? Well, the crystal ball didn't really say anything about speed. So what's our safest bet? Negative gamma. What's our strategy here? What's the only one out of those four that gave us positive deltas and negative gamma. That would be short puts. Most of you know that I'm not a big advocate of selling naked puts, and it's not my intention here to make that as a common strategy I'd like to see people doing. It's just to try and keep things simple. There are better ways to get positive deltas and negative gammas, but just to keep it simple, let's say that one strategy is to sell puts. If you do that, now you know with absolute certainty that as long as the stock goes up, you're going to make money. You don't know that if you buy the calls, because the crystal ball said nothing about the speed or the magnitude at which that stock was going to move. This is the only strategy we know for certain where we would make money. Does this happen in the real world? I've shown you this one before. Here's a little case study I like to show of AGIX, Atherogenics, and take a look at the stock was trading for $18.81 on September 16th of 04, and just 6 days later was up to $21.18. That's a 13% increase in the stock. But take a look over here at the calls. If you bought the October 20 calls for $4.80, 6 days later, oops, sold them for $4.70. Took a 10-cent loss even though you were correct that the stock price was going to rise. And that's because you've got a very big gamma component, really due to volatility. Little separate story, but the same idea. And that means the stock price would have to move even higher, or the same price here, but more aggressively, before that option would start picking up a profit. But take a look at the puts over here. If we had sold the put for $5.50, positive delta, negative gamma, take a look what happened. We could buy it back for $3.90. There's one of the potential winning trades, and that's because we considered delta and gamma. So remember, for better results, we must consider the speed at which the stock price is expected to move. If you are expecting fast, aggressive moves, you can use positive gamma positions. However, if you're not sure, use negative gamma. And this is one of the most basic ways you can use Greeks for better options results. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course at optionsatoz.com.